evening to make sure that the information is being shared. If you've never met me before, my name is Hans August, and I'm actually one of the business directors here in New Jersey. I get a chance and I get the wonderful chance of working with Our Infinite Company. And one of the reasons why I tell people it's wonderful is because part of what we do is making sure that people have access to financial education. And tonight's presentation that I'm going to actually start sharing the slides with is actually called the Ultimate Wealth Building Strategy. And one of the reasons why this has become a very powerful conversation across the United States is because we're teaching people the language of financial literacy first. So that as they begin to understand how things work, they can better position themselves. I had found myself at the age of in my early 30s being in a banking career where I talked about money. I understood that people needed money. I understood that people used credit cards and different things, but I didn't understand the language of money myself 100%. But through the process of learning and becoming educated, I ultimately had a banking career and then got myself involved heavily in real estate, learning how to leverage real estate not only to create a income for myself, but actually make a profit. And in my ability to make profit, I found out that there's an idea called wealth. Because the very first thing that I had to understand in America was that there's three forms of money that we all have access to. And the very first form of money is called income. And that's where we make a decision every day to get up and get to a job. Nothing's wrong with that. It just means that it guarantees us a version of the money that we can make. That version of the money that we can make is limited by the idea that there's a certain amount of hours that you can work, there's a certain amount of salary that somebody can extend to you, or there's a reality that maybe that could also be taken away. But the second form of money that I began to invest in and learn from was the idea of a profit. A profit is where I learned about real estate that you can actually start a system of earning more income outside of the expenses that are tied to the type of business. So I was in the business of real estate and helping individuals buy property, help individuals sell their property, and then I began to work with investors, and investors taught me that I could leverage my time if I actually owned the property by leveraging the idea of a real estate property, whether it was a two, three, four, five, six, seven family, to actually earn income. And so I found out that the second form of money was profits and the ability for you to actually leverage a profit in your favor so that you can position your dollars. And then the last form of money that I begin to study is the idea of wealth. So tonight I'm going to teach you about the ultimate wealth building strategy. If somebody's invited you to this call, tell them thank you because you're going to be a great piece of information. What I'm also going to make sure is that you understand that there is something called an index universal life insurance. And I'm going to do a quick comparison tonight of that and leveraging a real estate strategy. So I highly suggest if you are here tonight, take some notes so that you can kind of position the information in your favor. But I'm going to walk you through some of the details that I believe will make a bit of a difference for you. So when I got involved in the real estate space, I began to understand that there were some challenges and risks that could be taken on. So tonight, I'm going to do the pros and cons of building wealth through real estate. Nothing's wrong with that, but I'm going to also show you how to leverage an index universal life policy. And some of the key questions that I'll focus on tonight are what are some of the challenges that I learned or and others may have learned in real estate investing? And then I'm also going to answer the question that how does an IUL literally offer a potential better cash flow solution? Or can an IUL literally complement or even replace a real estate wealth building strategy? So complement means that, hey, we can work together, or is it even an option to replace it? Because what I learned that the language of wealth said was that the language of wealth says, hey, in a business, you got to run it to bring in more money to pass your expenses in a profit. In a job, I got to work a certain amount of hours to make out a certain amount of money. But wealth says that I could take those income and profits and put it in the right place and invest it in a wealth strategy. So for me, when I understood real estate, it was based on the wealth strategy. When I started to understand what wealth really was, wealth was the byproduct of your money making you more money. As you begin to understand the values of that, you begin to understand that I had learned, and many others who have been in this space. So if you've been in real estate before, you might agree. But I would tell people that the strategy of real estate says, hey, listen, I'm actually going to purchase some type of property. whether it's a single family residence or multifamily residence, they're really going to hold that property with the intent to generate what we call rental income or appreciation. Appreciation is the same word as equity, but in order for you to be able to do that, you have to be able to potentially leverage your own money, or most likely you're going to leverage your own the dollars of somebody else in the form of a loan to be able to expand it. They call them mortgages. But the reason why I wanted to generate rental income or appreciation was really to just make more money. And I thought that if I understood that I had a certain amount of property, I can generate a certain amount of income per month. So strategically, what people taught me in the real estate space was that, hey, you're going to either buy this property to hold it with the intent to generate rental income, or create an opportunity that based on the time that you hold it, the value will increase so that you can take out the appreciation in the form of equity, lines of credit, or sell the property with the intent to make more money. Or somebody say, hey, Hans, why don't I show you how to fix and flip a property? It wasn't my favorite thing to do, but I learned that it worked. What that mean was that literally I could find an abandoned property, or I could find a property that's not in the best shape. I could find a property that is, in decent shape and somebody wants to sell it to me at a great price. And what I will do is improve the property from either soup to nuts of making it look fabulous as far as roofs and other siding pieces and greater windows so that the new person who wanted to buy it from me would pay me more money. And what that happens is a fix and flip is a period of a year or less, maybe 6 months, depending on the condition of the property where you improve it. And based on the approved price and the appreciation of value, you sell it to make more money. My favorite became short-term rentals, whether you could lease a location or you can buy a property itself. You can take that property and you can literally leverage it to others for a day or two or three, maybe for a vacation period, maybe for a work assignment. Nurses would come into town near the hospitals where properties were at, and they might be there for 2 or 3 months, and they would pay you a daily rate. Or a vacationer would be in town, they need to be here for 3 days, or they had a work assignment, or they had a business activity that they were fulfilling, conferences and things. They would rent it out at a better dollar than you can get in a monthly rental income. Or if you were involved in commercial real estate, most likely you can buy a commercial piece of property that's located in a particular area with the intent to rent it to another business owner. Laundromats, you can lend it to a child care, not lend it, but rent it to that area. And that's how real estate generally works. There's plenty of other strategies, but this is really the basis of it. As I begin to learn about the business and learn about the positioning of how I can grow my dollars, I begin to realize that there are certain challenges and risks that happen in the ability to manage property. Doesn't mean that it doesn't work. It just means that there are some challenges and risks to anything that you do. And in the challenges that I found out, or the risk, was that I always had to put a lot of money into the deal. I can borrow somebody else's money, but I still had to give it back. I can leverage my own money, but I had to leverage my money to make that deal work, which means that if I'm buying a property for 100 grand and I got to put $20,000, 20% of my money needs to go into that deal because I don't plan to live in it. I was an investor. If you are a first time home buyer, you can even get 100% financing. You can get 3.5% down. You can get 5% down. But as an investor, I realized that I need to leverage high capital or high down payments. And then in order for me to make the deal work, I got to go borrow more money from a bank. And what that means is that I might have to get the other 80%, the $80,000, and I'd have to go and get the loan from the bank. And that's how I understood that I became responsible for the loan. And I also had my money working in the deal. But there was things called market volatility, which means that property values can actually decline in certain areas. Today, that might not be a common theme. Maybe values are going up, which means property are more. So depending on when you bought something and now you can sell it in the future, but because there's an option that a property can decline, you can potentially lose value, or maybe that's not the issue. The issue was that, hey, sometimes you got great tenants who pay their bills on time, they pay their rent, they're studious, they got great credit. But if they lost their job and they don't have any savings or they don't have any positioning to keep the expense of the lease or rent, you might run into a tenant issue. Or maybe it's not even that. Maybe you might run into somebody who is a great payer, but there are maintenance realities that you have to deal with property damage or high care repair costs. You can have a beautiful home, but if the roof is out, you might have to spend $10,000, $15,000 of your money or in the form of borrowing money to take care of the needs of a property. So I tell people, as you begin to understand how real estate works and how it becomes a reality, there could be some liquidity challenges you can run into. If properties decline, you may not be able to access the equity in the property the way that you wanted to, or the amount that you needed. Or if I needed to get more money out of my property, I have to refinance that property, which is borrow more money from the bank or get it in the form of a line of credit. Or the only ultimate option is to sell. So I tell people, as you begin to understand the tax realities and the time management realities, you begin that there is property taxes, there's capital gains. And all that really means is that there's nothing wrong with the concept, but there are some realities that you have to be able to manage in order to operate in the space, yet alone finding the property. And as I begin to understand how that worked, one of the things that my wife and I desired was the ability to begin to understand how can we grow wealth? And wealth was the ability for us to have money working for us rather than us always working for money. But as I begin to understand the math of every transaction that I participate in, see, because when you have time to think, you begin to study things a little bit and you begin to understand things a little bit. And one of the things that I found quickly about a mortgage was a debt or a responsibility that I had as an individual while I borrowed that money from the bank. And two things that I found out. One was the ability to understand that there is interest that I'm not paying to myself, that I'm literally paying in over to the bank over the course of time. I literally began to understand how I studied how my money that I paid moved over to the bank's hand. And I also understood that there was a potential loss opportunity. Now, strategically, as you begin to understand real estate, there is always leverage points that are in your favor. But there is realities that if you understood what to do with your money otherwise, you can be able to compare and contrast the risks of what you want to do. And I call that opportunity. So what I learned was that the truth behind a mortgage debt, which is not illegal in America, is that even if you have a 5% interest rate or even less, you have to understand how your dollars in that mortgage is being positioned. And what I found out very quickly was I started to run the math. That was my wife's favorite idea. She'd say, run the math. And so she would say, let's find out the numbers. So she's an accountant by trade, so a lot of it is math driven. So when we understood the mortgage reality was that, hey, $300,000 I borrowed from a bank at a rate of 5% or less says that at least at 5% that payment would be $1,610 of monthly. Now that sounds excellent. What that means is that all that really means is that at the end of the day, I had a beautiful payment, but once I understood what an amortization schedule was, an amortization schedule is what you receive when you close to say, how much money are you going to hand over to the bank in interest? And I quickly began to study that even if I was in a property for a 30-year period and I bought it for $300,000, I am liable to double the amount that I am going to pay to them based on leveraging their money, basically. And they say, hey, Hans, if you leverage my money for the next 30 years, you're going to pay me $279,000 in interest plus the $300,000. And they say, Hans, if you leverage my money for even a month, you'll pay me at least $1,200 in interest and only $360 of that money. And I begin to understand that the math said that 78% of my $1,610 is going to go over to the bank. Now, mortgages are not illegal, but if you begin to understand how money works, now you begin to position your understanding on how you're going to leverage it in your favor. See, the study of wealth says to me that I got to leverage understanding to position my dollars in my favor in order to leverage the money in the best place. So when somebody taught me a wealth building alternative, I was all ears. And one of the wealth building alternatives that you can leverage in the space of building wealth is what we call an index universal life insurance policy. So what is an IUL? An IUL is literally a permanent life insurance policy. But one of the reasons why people consider it is because there's a cash value component in it. And that cash value component allows you to earn interest over the course of time in stock market indexes like the S&P 500. The S&P 500 literally says, hey, I'm the 500 highest best companies in America. And based on the valuations and the interest that you can work in that market, we can tie the cash value account to that type of a performance so that we can position our dollars to grow. But there was something that was very unique that caught the most attention because I understood what interest was, not only from going over to the bank or potentially making it somewhere else, but I understood that I can position this type of account to create what I call a distribution of income. I can create cash flow. Now, what was unique about it was that I began to understand that the reason why I built real estate was because I wanted to create cash flow and I really wanted to create making more money. And I said, well, if an IUL has income distribution and cash flow, it's pretty much like a rental income, except for it's an account that I can structure that has a life insurance component, has a cash growth. And what I found out the benefits were, hey, I can take the ability to create a form of equity protection, which means that, hey, unfortunately, if I passed on, I can pay off that property or that house, depending on the policies that I had on it. Or B, I can appreciate the values of my dollars over the course of time. But there was something that was also very much unique, meaning that based on the laws of this type of account, it says that there's an upside potential and there's something called a zero floor. A zero floor means that if unfortunately the markets were not doing well because we're not directly tied to the market, the worst case scenario is 0% would be interest added to that account, but I wouldn't lose the upside that I gained, or I wouldn't lose the values of the dollars that I contributed in the account outside of the cost of insurance. So I tell people when you begin to understand that the rule of 7702, which is an IRS code that I want you to study tonight and learn a little bit more, it literally says that it can create a tax advantage for wealth accumulation because what that means is that I'm now in a structured tax shelter that creates a tax advantage that can help distribute income. And now I don't have to pay taxes legally. I don't do anything illegal because I don't got any time for any jail potential. So I tell people if you begin to understand the laws, and I said, well, let me just do a quick comparison. Nothing's wrong with real estate, but there are some strategic challenges that you're going to run into. And I said, well, what does the difference between a real estate project and an index universal life potential create? What I found out was that if I took the same $100,000 that I needed to put into a property, if I was purchasing it at a half a million, that's my money that I've earned, or my wife's money that we've earned over the course of time, and we put it into a project that's worth a half a million dollars, and we purchase it at that price, we're still going to have to go get $400,000 from one of the banks that will gladly take the interest from me over the course of time because that's how the mortgage is actually structured. But then I need to earn income because the whole idea is that I'm an investor and I'm going to either rent it out to a short-term rental type of strategy, or I'm going to rent it out to a property owner over the course of time. So depending on the cash flow that I can generate on this property, for example, if I generated $24,000, but I still had $12,000 worth of expenses, mortgage payments, taxes, insurance, depending on how you purchased it. Some people buy these properties free and clear through cash, but you still have an expense and you still have a capacity based on what you can earn over the course of cash flow, depending on what strategy. So let's say you netted $1,000 per month, which is great, which means that it at least positions you to pay off the expenses, but you have to tie it into. But because I understood the market risk, which was the fluctuation of value or the potential tenant challenges that could pop up, I begin to understand that through taxation and my only ability to liquidate through the process of either selling it or borrowing our money, there were risks tied to what I did in real estate. Although one of the biggest components of real estate was the idea that the values of your dollars can grow over the course of time, I still had to find the property. So when I understood the logic of an index universal life and its ability to create cash flow, I said, well, what if I took the same $100,000 and I put it into that type of account? I wouldn't actually have to find myself a mortgage, but I can still create the income distribution and the growth value of my cash. And then I can position my dollars for no market losses, but I can, because it has a guaranteed floor. and then I can create tax-free cash distribution. What was interesting as you begin to leverage money in real estate, your distribution of rental income is actually considered income. And there are taxes that you will pay on the property. But if I could do the same thing, establishing an account that gives me benefits of making sure that if unfortunately I passed away, that would be paid out. But the main reason is I don't believe in death, but death will happen. But essentially, what I tell people is now I can build the value of my cash over the course of time. And then I found out this key component. I can actually borrow against the dollars in my account, leveraging it against the loans to use it to do smart things, and I can grow the value of my benefit or the value of my cash over the course of time, just like appreciation that you can gain in actual real estate. So I understood that one of the key things that you want to consider about understanding how an IUL generates wealth or cash flow is that you're going to be in a tax-free environment, that you're growing your money. You could position your money not to lose any dollars, and you could leverage it just like a real estate project. You can create yourself a bit of self-financing over the course of time of leveraging the dollars over those accounts, because the same way you would borrow money from a mortgage, what if you borrowed it from yourself with the ability to futurely create what we call a passive income source, thereby converting the cash value either into a stream of income or being able to leverage it as a form of retirement dollars. So I tell people, when you begin to understand the benefits, I begin to understand that there were certain challenges that I can begin to overcome in the real estate space, because I ran into liquidity challenges, which means how do I get money moving in my favor? I can reduce my risk, not having to worry about tenants and payment and property damage. And I've seen it all. I tell people I don't know everything, but I've seen it all. What I tell people is I begin to understand that I can create tax efficiencies, because the way to build wealth in America is to beat inflation and to be able to beat taxes. And if I can beat taxes legally without going to jail and creating a tax advantage, I can understand that I can create a long-term security by creating cash value that continues to grow while my real estate may end up facing some sort of potential downturn in the future. Not always the case every day, but I understood the benefits now. So when I have conversations with people, what we're really doing is saying, what are the benefits of the strategy that we're going to put in place? And then there is a future that I got to worry about. In real estate, properties are deeded. They have to make sure that there's owners tied to it. But depending on how you did that paperwork and who was involved in the conversation, how does that get properly transferred over to your family? And I quickly learned in the space of life insurance or leveraging it as a wealth building opportunity, I can literally skip the conversation of probate. If you've never heard of that word before, probate just means that you got to show up in front of a judge so that he can tell you what to do with your asset if you didn't properly structure it. So I understood that because I can leverage the idea of a beneficiary, I can create a direct passage to my wife or my children in the form of life insurance while I'm growing the dollars of my account. But I said to myself, what would I do with all of this real estate experience that I've had? It doesn't mean it doesn't work. It just means that there's challenges. And what if I took the same ideas that I learned in real estate and I combined the strategies, the two? See, the whole idea about building wealth is the ability for you to grow your dollars in your favor so that you can have access to the interest, access to the potential growth. So I could say I could actually literally use my IUL to fund more real estate, either in the form of a down payment, or maybe if there's enough money, instead of getting a mortgage, I can use that money because I can access the money over the course of time. Even while the values of those are continuing to grow, I literally can protect my rental income, which means that you need access to cash when tenants are having problems. You need access to cash if you have to go to court. You need access to cash if you have to have a conversation with an attorney who has to step in on your behalf because of how the case is actually structured. So if you're growing cash value and you could immediately access it, then you could position leveraging this as a two-pronged strategy, thereby creating legacy. Legacy is my favorite word. The whole reason why I work hard every day is with the intent that what I do today is going to position my children and my grandchildren and my wife or the family members that are behind me to create more value for them in the future. As you begin to understand the benefits, strategically, two things happens when you're growing money in this space. Well, let's say you didn't make it over a year. I understand that because there was a possibility, but we won't talk about that tonight. But I tell people I leverage the understanding that now that there's a death benefit in place, the money that can be extended to my family will supersede my ability to potentially grow a portfolio over the course of time if I strategically leverage it in the right way. So every day counts because time is one of the factors. But let me give you guys a case study before we wrap up tonight. One of the reasons why I begin to understand the value of understanding and leveraging wealth through the ability of leveraging an IUL because of the type of account it is, or leveraging real estate, I tell people, I said to a peer of mine, let me show you how we could leverage a $500,000 over the course of time. He says, I'm all ears. I said, well, what if we strategically took the $500,000 that you have access to currently out of this transaction and we're going to position it in an account that can not only give you a death benefit, but it can grow you position of growing the dollars in that account subject to the interest that it earns every season. And if we strategically position where you didn't have to contribute, we're going to instead of lump summing the 105 half a million, we're going to strategically put $100,000 per year for the next 5 years. And he says, well, wow, how would that work? Well, first, every year outside of the cost of insurance, which means that if unfortunately something happened to you tomorrow, and literally you passed away, $2 million would be immediately transferred to your family, skipping the conversation of probate and positioning your family in a better position. They would be sad that you passed away, but you know that you'd be able to send them $2 million tax free. But I'm going to believe that you're living so that over the course of time, the values of your dollars that you contributed outside of the cost of insurance will grow strategically in an account that will add interest over the course of time. And then I'm going to show you how to access it so that by the time you turned in your 40s, the same $500,000 would be valued at $527,000, $309, but I can create access of up to $497,000 at that time. Specifically at the 10th year, I can position the dollars to be now valued at $185,000 more than what you contributed to the account, still extending a death benefit. And now this is money that's eligible for you to potentially borrow over the course of time. Year one, we're not going to be able to borrow any funds, but we're going to position your dollars to grow. But over the course of time, by the 5th year, you'll have pretty much close to that $500,000 access. But by the 10th year, the strongest period in this account, you'll be somewhere between $728,000. He says, Hans, can I take out any of this money? Yes, you can. As you continue to value the dollars of your growth, you can access this money in the form of a loan. So if you had another real estate project that you wanted to do and you had a $100,000 down payment that you needed access to, not only is your money growing, but you'd position yourself to make sure that you can leverage it just like you would do in the form of a loan or in the form of a mortgage. And then you can strategically begin to understand that if you wanted to take out dollars in the form of cash flow. I said, well, what year would you? He said, what about if I leverage it at 54? At age 54, based on the value of $1.2 million. So now your account is now since doubled from the time that we've been able to grow the cash in that environment. We've given you access. Now we can create a form of what we call a guaranteed income source. If the account is valued at $1.2 million at that time of age 54, we literally can take out $106,000. If you wanted to do it at 55, it would be $109,000. But this would be a six-figure source that you can create based on a strategic play of using a $500,000 strategically. And so I tell people as you begin to understand that some of the best people that I've had conversation with is everyone. What that means is that you can strategically use the same solution to position your dollars in your favor. But when we talk to real estate investors, maybe you're looking for an environment that can create liquidity and you can kind of be in a risk-free space. If you're a business owner, you have a great desire to do real estate, but maybe timing and your ability to go find property and do things, this could be a great alternative for you to not only create a cash flow, but to position your dollars to grow in a tax-free environment. If you're a high income earner and you're a producer and you kind of do certain sales and you trying to figure out how to grow your dollars and leverage some of it and kind of become a tax advantage situation rather than giving it to Uncle Sam? What if you strategically positioned it over the course of time, understanding what your options are? Some of the people that we talk to are sometimes retirement savers, meaning that you want the challenges, but you may not want to put your money at risk, but you want to be able to create the growth. So what we do is we actually have you go back to the individual who's invited you to this call so that you can strategically have a conversation. We do conversations with the idea to say, let's show you strategically how you can develop a form of cash flow, but we're going to have a conversation. That conversation is in the form of a session with us to kind of discuss your financial goals. So tonight, if someone's invited you, I hope the information has been of value tonight. Please get back to them to ensure that they can review strategically what they can do and what your financial goals. My name is Hans Augustin. I'm actually one of the business directors here on the platform. I hope this information has been valuable. I'm going to open up tonight if there's any questions that anybody may have before we wrap up, so that hopefully this information has been beneficial with you. Any questions tonight for some of our invited guests to see if we can answer anything that might be fruitful to you tonight, and hopefully this information has been of value tonight. Any questions tonight? All right. I really appreciate you guys for taking the time. Do me a favor, next week, Thursday, we'll be having the same type of call. If you believe this has been valuable to you, go ahead and invite some of your peers, your contacts who may want to understand how to leverage real estate or leverage other wealth building alternatives. I'm your host and guest tonight. My name is Hans Augustin. I will see you guys next Thursday at this time. You guys have an excellent, excellent evening, and thank you for becoming more financially literate in this space. Thank you, guys.